Hi, I'm Bill Baruch, president of Blue Line Capital, and I'm here with our analyst, Jannis Meindl, and it is the Triple Play podcast where we give you a macro backdrop and cover 3 stocks each week. We got a great one for you, a lot going on in the environment. Let's kick it off with the macro, Jannis.
Yeah, I'll just run through last week's data here with CPI and PPI, and then I'll kick it back to you for what we got with the Fed and stuff this week. So consumer price index came in at 6% last week. A continued deceleration in prices, and then more significantly, though, if you look at the monthly contributions and sort of what is driving inflation at this point, you really see that from the 0.4 monthly contribution we saw with CPI for February. We saw a 0.25 of that is shelter, which we know is a lagging indicator, and that is set to contribute the most going forward to the number, although new rents have rolled over substantially already. So we should ultimately see a more disinflationary or deflationary impulse from the rents, from the shelter, which is about a third of overall CPI. And if we just look at services CPI less shelter, which is sort of one of the main things that the Fed is looking at because it's an indicator of what wages are, that is coming down, although it's ticked up a little bit in the last 3 months annualized. And then if we look to PPI, that one's come down substantially at a year-over-year increase of 4.6%. But if you look on a more granular level of what's driving that number, what's driving producer prices, you see that 3-month average annualized numbers are coming down substantially, except in construction, which continues to be high. There seems to be a lack of workers in that area and a lot of investment demand, especially as you look at all the fiscal initiatives. But overall, we do see inflation trending in the right direction. Bill, I'll already kick it back to you and what we got with Fed and stuff this week.
Great. Thanks, Jannis. Yeah, we got 25 basis point hike from the Fed. Their terminal rate right in line at 5.1%. The real thing is we're in the aftermath. We are seeing the expectation of Fed rate cuts reemerge through year end, 75 basis points from the current level. We're at 4.75 to 5%, and the market, the CME's Fed Watch tool is pricing in 75 basis points worth of cuts down to 4% with a better than 50% probability through year end. Now, the equity markets reacted fairly well through the early part of Fed Chair Powell's press conference, and then turned lower. I noted in some of the stuff, our information, Blue Line Futures, Midday Market Minute, and some of the research we put out, Morning Express, that this was more about Janet Yellen and some of the comments in the banking sector that sort of was of an undertow to the market into the close. So it remains to be seen, kind of how things get out of this week and how we finish out. But the real story, the real narrative is from a macro standpoint, is the fear of tighter credit conditions and what that's going to do to growth. But I think in how we're looking to play it, it doesn't change our theme that we believe tech with an emphasis on semiconductors can really outperform in this environment. Flash PMIs coming out Friday, so we'll see how growth is from that side. But let's jump into the stocks here, and we got Illumina, which is a life science company. Now, we do not own this company. Thermo Fisher is our horse in the race here. It's a high growth name. It's sort of a speculative high growth name in many respects. And it's been taken down pretty hard here over the last year and a half, as you would imagine. Now, from our theme of looking for next 12-month earnings to be lower than the trailing 12-month earnings, this does not fit in there. You have a next 12-month at 92, trailing at 7.7. Carl Icahn is an activist investor here, which is something really to kind of take away. And I know this name is on your radar, Jannis, so I'm going to let you talk about it here.
Yeah, so the main thing with this company is really that it is a house that's sort of on fire, and that's also why Carl Icahn stepped into this name and where he sees a lot of potential of turnaround. So if you just look at the fundamental metrics, you talked about PE at 155. A lot of the free cash flow metrics have really gotten beaten down, and a lot of that is the result of a lot of mismanagement in the company going on. If you look at the Grail acquisition, so Grail is ultimately a life sciences business that's not generating any revenue with aspirations to do so in the future in the cancer space. So what they have done is they have disposed this asset as sort of venture capital investment. They sold it, then they bought it back for $8 billion. Then they had to take a write down of that multi-cancer testing segment that Grail is. And now they're getting challenged by EU regulators who might force Illumina to dispose entirely of this asset, which could in turn trigger a tremendous tax charge that Illumina might have to take of $1.75 billion because they went forward with this acquisition the void of getting regulatory certainty ahead of time. Grail does not really generate any revenue in the EU, but it's basically taken on this massive risk without generating any free cash flow from that segment. So that's where the mismanagement has happened. And then if we look overall, Illumina is a life science company with focus on next generation sequencing. What does that mean? You put a sample into their machines, they give you the DNA output. What may that mean for future disease, early detection of different cancer types? And that's really where they're active. And while there are secular tailwinds, you have these micro concerns that Icon is highlighting. And that's what I think he sees with this company, that you have the tailwinds like a globally aging population, that early detection of cancers will be crucial in managing this aging population. But ultimately, this is a turnaround story, not something that's in our portfolios here for clients. But yeah, it's something to keep on our radar, especially as we look at the broader life science space with Thermo Fisher that we own in portfolios. Bill, I'll kick it back to you.
Yeah, this chart just really highlights it all. You've seen this thing fall out pretty heavily. We'll get that up there. Now, I went back about a decade on this chart. You can see this trend line breakdown more recently. That's going to bring a back test of resistance. You also have a lot of volume has changed hands from previous highs to previous lows. It's going to be a really tough area that we've highlighted in the chart for it to get to, even to really try to get above there to even make it towards a 382 retracement. So a lot of technical headwinds here too. It's going to be an interesting one to watch. It's going to be a very speculative name this year. So keep an eye on it. It should be fun. Let's move on though. Intuit. Intuit's a really great name. I mean, everybody knows Intuit from the QuickBooks to TurboTax, even MailChimp. Now this fits within our theme of next 12-month earnings. Yeah, 28. The trailing 12-month earnings at 60. Now, again, we don't own Intuit right now. We did have exposure to it in 2021 when sort of high growth software was really sexy. But we were out of it before it made a new high at the end of 2021. It was sort of one of those big jumps you see in the chart. But I think with this name, one of the things, our exposure is in Adobe right now, and I really like Adobe. One of the things about this name is you're seeing some of the growth, some of the revenue growth start to slow. What is that? Annual revenue growth, 11% is expected for next 2 years. That's down from 12.8%. Free cash flow margin as well at 25.5% is an improvement, but it really hasn't improved much. You go back to 2019, free cash flow margin about 25%. It's a name that we're going to continue to keep on our radar. But again, Adobe, I think, is the one that has a lot of more irons in the fire right now, given some of the the artificial intelligence, the sort of way of looking at things in automation and whatnot. I think their hands are going to be have potential way to outreach a bit more, and what some of the high flying themes that we could see in the next couple of years. But Intuit's definitely one to keep an eye on. Jannis, what do you have for us on this?
Yeah, I would largely echo everything that you mentioned there, with being pretty similar to an Adobe type business. It's focused on the SaaS side. They provide with services like QuickBooks, MailChimp, TurboTax. Everybody really knows this company besides knowing the parent's name. But yeah, revenue growth is still expanding at a rate of 11%. That will be crucial to watch as this company grows. As companies grow in general, you have to watch whether they can keep up the growth and also have stable margins in the process. As that tends to happen, margins shrink a little bit, and you ultimately need to weigh the different SaaS players and which products are more mission critical for their clients. And while Intuit is definitely mission critical for small and medium businesses, Adobe has more exposure across a broader set of clients. So that's the rationale there. If you look at the tech space in general and some of the concerns that have come up over the years with rates marching up, you see that Intuit will have to roll $500 million in debt in the next couple of years. That should not be a problem because they have $2 billion on their balance sheet. So you have that taken care of. If you just look at their solvency position in terms of comparing EBITDA with interest expense, they're positioned rather well in that area. So you don't really see a lot of those threats that you might have seen with a lot of stress coming up in the technology space around Silicon Valley Bank loans that they have made. It is that theme that we talked about last week with Adobe, the big players getting bigger in the space. accruing more market share. And you also see that with Intuit here. If you just look at the peer group and some software companies in comparison, especially Adobe, they are right in line with their revenue growth numbers. If you just look back over the last 12 months, Intuit has grown revenues by 20%. As you mentioned, Bill, that's going to take a step down to 11% over the next 2 years as analysts expect that growth will come in a little bit. It is a lot of renormalization here, and I think what we shall see how the market likes the SaaS space in general. Our focus is on Adobe right now.
Yeah, I think it's a lot of great points there. It is tax season, and you kind of get this sort of buy tax season, maybe sell after tax seasons. You got a little bit of bump up. I mean, the broader tech space has really moved up pretty well here in recent weeks. But there's a lot of resistance overhead. I think nice little double bottom in the chart. We got a 50-day moving average and 200-day moving average have highlighted. We're out above them right now, but we are running into some resistance. It's going to be one to watch here. Again, it's always on our radar, but Adobe is the one we own right here. So let's move on. We'll finish off with energy. Pioneer Natural Resources. The world runs on petroleum. We don't own Pioneer right now. We actually cut it at the end of last year. And that was more of a move to shore up some of the energy exposure that we have. And that was right after crude oil just continued to struggle to really get above $82. And then since then, we've seen crude break $70, trade as low as actually $64 this week. We're regaining 70, but I think a lot of volatility is still to come here in crude oil in general. And now when you own an exploration and production name, you're going to be tethered to the price of crude much more closely than say, an oil services company. But Pioneer, I think there's a place for this in your portfolio, and it may be getting there, maybe getting close now. So it's really closely watched on our radar. We did trade this one off for Schlumberger, which is a name that we covered in recent weeks. I do like, a lot of these energy names, you're seeing multiples really, really low. You're getting a 7.8 right now, next 12 months. That is up a little bit from the trailing. One of the things that I do note here is the Pioneer's CEO, Scott Sheffield, is talking about the free cash flow. Free cash flow is going to be about half of what it currently was. So what is that? Free cash flow yield in the last 12 months is 15.4%. But due to oil service cost increase, you're going to see that cut in half. That could really be a headwind here or something like that. But at the same time, the U.S. has really struggled to increase production. So production is going to be crucial. Increasing production is going to be crucial in the coming years. So despite what we hear from the White House, I think that we're going to see a bump up in production in coming years, and Pioneer is going to capitalize on that. But in the near term, I'm really focused on some of the seasonality that we're seeing. We're at the onset of here, where gasoline can really outperform at the end of March and take that into Memorial Weekend, the early part of June, and refining margins can increase, and that's more emphasis on a refiner like a Marathon and Petroleum. So we've traded off Pioneer in recent months to have that Schlumberger exposure, increased Marathon Petroleum exposure, got our toes into Cheniere with LNG is this ticker symbol there. We've covered those names. But we like Pioneer again. It's on our radar. We're going to continue to watch it. Jannis, let's what do you have for this? What do you have on this name?
Multiple different themes with energy in general, and we've covered energy names in the past, and it's pretty consistent with what we've talked about there. You see the global energy underinvestment story as a result of regulatory uncertainty, and also the lack of long-term commitments that stem from the fact that you have regulatory uncertainty. I think there's a lot of word out there still that European utility companies are actually not committing to long-term LNG contracts, and sort of a similar theme is true of all these oil players. But the big advantage for a player like Pioneer Natural Resources is that they are running on shorter cycle oil production. They are a shale producer, one of the major ones in the Permian, and as a result, clients don't have to make those long-term commitments that they are afraid of in the midst of an ongoing energy transition, what that may mean for regulation in the future. So you have energy underinvestment, that's definitely for real. And then you also have the fact that a lot of the developing countries, they have not really started to consume oil in the way that you would expect they would as they become more of a developed world sort of society. If you just look at growth rates of oil consumption in Asia Pacific, but especially in Africa, that's been really low. And in the fullness of time, that will pick up. We see the globe consume about 100 million barrels of oil here this year, and that is probably going to increase, barring any sort of substantial innovation in the battery space. I think that oil consumption is not really going anywhere for the time being. So underinvestment is critical in order to meet that increase in demand. If you think in general about these oil players, they've really gotten wrecked by a lot of overinvestment in the past, these companies being too focused on volume over capital discipline. So this chart here that you can see just showcases from the early 2000s until 2015 how much credit all these different E&P companies have taken on, and they have taken on substantial amounts of debt. That is not as much of a problem, or not at all a problem anymore today. So even though oil prices are around $70 right now, nowhere near the $100 mark as of this moment, you do see that these companies are a lot more resilient because of the strategic shifts that they have made towards capital discipline rather than being too focused on volume growth. And then if you just look, you mentioned with the oil services companies and them restraining production potential, which is sort of indicated by the fact that the U.S. is not producing at peak production levels, which was closer to 13 million barrels. But it seems that a lot of the companies have profited off of cheap wells that they were drilling way back during the shale boom in 2016. And as a result, their reserves are still quite high. And Pioneer Natural Resources in particular, with their production in the Permian, does have a really strong reserve space. So if oil demand continues in the foreseeable future, if oil stays stable or rallies, then Pioneer will be a shorter cycle producer, really well positioned in that space. But we'll cut it short. You can check out the entire chart book with all the additional info, and I'll kick it back to you, Bill.
Yeah, you make a good point. The chart book, we put this together. Jannis really spearheads this and gets a great chart book together for you every single week. We try to tighten the time up from a little longer than 20 minutes last time. We're trying to get under 20 minutes this time for you. Finish off with the chart here. Pioneer Natural Resources, we're back testing the breakout. So this is a crucial area for Pioneer. Watch it very closely in the coming weeks. Back testing this area. But one thing that's really important, one of the reasons why, too, it sort of highlights you get these exploration and production companies that are really coming in due to the price of oil coming down. And I have a chart for you with Pioneer relative to the XLE. And you can see that underperformance in really the end of last year and coming in through this year, where it starts to roll over a little bit. So we're at a crucial sort of inflection point here for Pioneer. It's on our radar. Watch it closely. Check out the chart book, and we would love to hear from you. Anything you want to talk about with some of the names we've covered, any questions for the names we've covered. Hey, if you have any suggestions for names that we should cover, we would love to hear from you. Give us a shout. You know how to reach us. And thanks a lot for listening. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.